This house in Monroe is listed at $675,000, and I'm going to be talking about what it would look like to get an FHA loan on this place specifically, so you can hopefully have a little bit more concrete and reliable information as you're starting to think about that process. So I'm going to walk you through a real quote so you can see what your monthly payment might be, including a breakdown of each of the components. I'm going to discuss what income it would take to qualify for a couple different scenarios for a 3.5% down and a 10% down scenario. I'm going to talk a little bit about the process of getting an FHA loan, and at the end I'll also explain one of the main things to be aware of on FHA that not everyone knows. My name is Landon Buteau, and I'm a mortgage advisor based in Bothell, Washington with Cleveland Street Mortgage, and this channel exists to help you in the early stages of thinking about buying a house. So let's get into it. All right, real quick, I just want to skim through a few pictures of the house so you know kind of what you're looking at before it's just a bunch of numbers. You can see there the house is listed at $675,000, 3-bed, 3-bath, and listed in Monroe, Washington. I live in Monroe. Really like the area. We'll skim through a few pictures here. I actually really like the style on the inside of this one. I'm not a real estate agent or an interior design specialist, but my wife and I kind of like the style where it's not super modern. It's got a little more character, and it's bright, and it's not, again, it's not brand spanking new. There's no crazy recent updates, but it is updated and it looks to be in good shape. Just looks like a fun place, cozy place, nice little backyard, a little bit of space, and good area in Monroe. Real quick, a couple features on the house is single family residence, which is important for financing. That tends to be better as opposed to manufactured or condos or whatever. Built in 1997, 6,500 square foot lot, and you can go through here. There's some good features about the house. Close to Lake Tye, neighborhood parks, trails. Lake Tye is a nice area to have close by, just especially in the summer. Fun outdoor activities there in Monroe. And then one thing I wanted to note specifically is on the financing. They mention on the listing terms, cash out, conventional, FHA, USDA, VA, all good to go, which is good because we're looking at FHA specifically. And occasionally people will specify that they just want conventional or other terms of financing, but we're safe here. And then real quick, I want to show you, they show that the kind of tax estimate down here, public tax history. In Zillow, sometimes they usually import those directly into Zillow so you can have an idea of what your taxes are. And a lot of times those are good, those are spot on. But if you wanted to be really sure, you can click, they link to the county website. And I've already pulled that up here. You can see they say it's $46.40 for 2022. And I've pulled that up here. If you click that link, it'll bring you to the tax statement for that house, and you can get a lot of information about it. And here you can go down and see what the total is for the current distribution of taxes, and $46.40. Zillow got it exactly right, so we're good to go there. So let's get into the financing and the numbers. All right, real quick, I'm going to walk through the assumptions that I'm using to create the quote that we'll look at in just 1 second. Obviously, the house is listed at $675,000, which is the purchase price that I'm using. Taxes of $46.40 annually, we just saw that. And then homeowners insurance of $1,800 a year is the estimate I'm using, about $150 a month. And you can end up with lower than that. You can end up with higher than that. You'll be the one choosing your homeowners insurance. So that's up to you. This is just kind of a reasonable average that we found in our area for this price point. And then credit score of 700. And, I'm not going to overanalyze this right now, but generally a little bit higher credit, a little bit better pricing, a little bit lower credit, a little bit worse pricing. I'm assuming first-time home buyer, which won't have as much of an impact with an FHA loan, but I list that as an assumption because I'm going to briefly mention a conventional loan later. And that quote that I'm going to look at is assuming you're a first-time home buyer, which sometimes improves your pricing, gets you into better loan programs. And then real quick, I wanted to talk about debt to income ratio. Basically, And there's more to this, but just as a quick summary, because that's not what this video is about, without getting overly detailed, debt to income ratio is the ratio that lenders use to determine whether you can qualify for the loan. And what they do is they figure out the resulting monthly payment, and they take that and divide it by your gross monthly income. And if that, they need your total monthly debt over your gross monthly income, and generally that needs to be 50% or less. On an FHA loan, if they have what's called a back-end ratio of 58%. Typically, is you can go up to 58% with your total monthly debts, including any other loans you have, over your income, and that could go up to 58%. But on the front end, which means just the housing payment, that still has to be below 50%. So I'll look at that real quick later. And then real quick, I wanted to describe, who would end up in this kind of situation where they're making because it is going to be a high, it's going to be a high payment. The scenarios that I'm going to look at are going to be $4,000 a month plus of a housing payment. So who would go FHA and end up in that scenario? Without getting into too much detail, because it could be anyone. There could be any number of reasons why that's the best fit for you. But generally speaking, it might be someone with low cash, not a ton saved up right now, but high income, so they can qualify for a high monthly payment. And they're motivated right now. For whatever reason, there's a good reason to buy for them right now, instead of waiting and maybe saving up a higher down payment. All right, you can see I've got two quotes pulled up here, and on the left is the 10% down scenario, and on the right is the 3.5% down. And I didn't mention earlier, but the reason I'm going 3.5%, 10 makes sense. It's a nice clean number. 3.5 is because that's the minimum you can put down for an FHA loan. For a conventional, sometimes you can go with 3% down, but for FHA, the lowest you can go is 3.5. So say that's all the cash you have, and you want to go 3.5. Here's kind of what you'd be looking at. And again, this is for that $675 purchase price. So let's start with the monthly payment. You can see the monthly payment is $43.95 on the 10% down scenario, and that factors everything together, all your components together. And the monthly payment on the 3.5% down is $47.01. So it's a difference of about $300 there. So where's that difference coming from? You can see each of these components that breaks it down. On the 10% down scenario, you're looking at $36.07 of principal and interest. Whereas on the 3.5% down on the right, you're looking at $38.67. So there's a decent chunk of difference there. It's about $260 difference. And that's going to be pretty intuitive because you're putting less down. You're putting significantly less down in the 3.5% down scenario. So you're going to have more principal to pay back. But a lot of times that principal and interest section also factors in a difference in rate. But if you look down at the rate section, what's interesting is that the rates are the exact same. Now on the right shows the APR, which is an equation that tries to factor in other components of the loan and show more of a real rate. But let's just look at the rate for now. It's 5.749 on both. And so it's not, the principal and interest is significantly different, but not because of the rate. The rate's the same on both, but the principal is significantly higher to pay back each month on the 3.5% down scenario. So then there's really only one other area that's accounting for difference. Taxes are going to be the same, insurance is going to be the same in both scenarios. However, the mortgage insurance here, that's something you have to pay when you put less than 20% down. And you can see here on the 10% down scenario, it's $252 a month, whereas on the 3.5% down scenario, it's $297 per month. So that's pretty high mortgage insurance. We'll look at a different option later that has lower mortgage insurance. But that's pretty high mortgage insurance. And you can see it's $40 a month higher on the 3.5% down scenario. And that's just because when you put less down, you're more of a risk that you're not going to pay back your mortgage. So the cost to protect yourself against that risk, or the cost to protect the lender against that risk, is higher. So you can see, the primary difference there is just going to be the principal. There's $50 a month of difference in the mortgage insurance, but that's not a huge dent in the difference there, whereas the biggest difference is just going to be the principal. We'll look down here at the cash to close. So estimated cash to close, 10% down, it's going to be about $80,000. 3.5% down, it's going to be about $35,600. And that cash to close is made up of your down payment, of your 10% down or your 3.5% down payment, plus any other closing costs. And you can see right above it, there is a other closing costs section. And this is what I was talking about at the beginning of the video that not everyone realizes about FHA loans. Most people are aware that there are closing costs on every loan. We generally budget for this rough price point for this area. We generally budget about $10,000, give or take, as just a very rough estimate for closing costs. We always look at the specific components that make that up and calculate that from loan to loan when we're giving real quotes. However, just as a general number, we talk about $10,000, but we're looking at $21,000 and $22,000. So where's that coming from? And this is what I was saying that not everyone realizes about FHA loans. A lot of time people look at FHA loans and say, oh, the rate's better, the pricing's better, I'm going to go with an FHA loan. And as we'll look at a conventional quote later, sometimes it is better. It is significantly better sometimes, and you might end up with a lower monthly payment than if you did the same amount down on a conventional loan. However, this other closing costs includes what's called a funding fee, an FHA funding fee. And in order to get an FHA loan, part of the reason the rates are better is because there is that funding fee that is rolled into your loan amount. So what you might have noticed is that on this total loan amount, it doesn't really add up to the 10% or 3.5% that we're using. 91.57 and 98.19. And the reason for that is we put 10% down. However, on top of the loan amount, on top of the difference between what we put down and what the house costs, an FHA loan adds the funding fee to your loan amount. And the funding fee is about 1.75% of the loan amount. And so they add that to the total loan amount. And then over time you have to pay that back. It adds to the total amount of money that you have to pay back. And so you can get better pricing sometimes, but you have to pay that back. And that can be, it's just something you need to be aware of, is that, you know, the pricing is, the rate is better, the monthly payment might be lower on FHA, but you're adding this significant fee of, you know, 1.75% of a $500,000, $600,000 loan is hefty, and you have to pay that back when you sell that house on top of paying back the loan for the house itself. And so even though you don't feel it immediately, it's good to be aware of that. And so what does qualifying look like with these scenarios? On the 10% down, you have a total monthly payment of $43.95, and I mentioned you would have to have a debt-to-income ratio of 50% or less. So assuming you have no other debts, then on that 10% down scenario, you have to have a monthly income of about $87.90. And annually, that's $106,000. This is a month, and this is annually. And then on the 3.5% down scenario, because the payment is higher, $47.01, you'd have to have an income of about $9,402. Again, assuming you have no other debts. And that's an annual income of about $113,000. And that income is in the eyes of the lender. So if you are self-employed and you've just started making crazy amounts of money this year, the lender might not view it the way you view it. They might say, no, you only make $50,000 when you think you make $120,000. They have different ways of figuring that out. If you're salaried, obviously it's easier to figure out what your qualifying income is. But if you're variable or self-employed or something like that, there can be more variation. So those are roughly what you'd have to be making to qualify for those kind of loans, assuming you have no other debts. All right, so I've talked specifically about what FHA loan would look like, and that's what this video is about. But I would be doing you a disservice if I didn't briefly give you a comparison to what a conventional loan might look like. So I am just doing the 10% down scenario versus the 10% down FHA. So here is FHA on the right, here is conventional on the left. Both are 10% down. And this one you can see the conventional has the true true loan to value of 90% because you're putting 10% down and there's no funding fee. So you look at that and you see, okay, the total monthly payment for conventional is $45.89, whereas the total monthly payment for FHA is $43.95. Now there are some other challenges, other features and other challenges that come with FHA. That's not totally what this video is about. My dad has a video about that I will link in the description on his channel, Mortgage Mastery Theater, and you can watch a total comparison. But this is just a quick look at this specific house, what the difference would be. Now you can see the rate is significantly higher for conventional versus FHA, and that's going to be the main difference of what puts your monthly payment so high on conventional versus the same scenario on FHA. You can see that the mortgage insurance is a little bit lower on the conventional versus the FHA here, even though they're both 10% down. So that's kind of the main differences that you're looking at. Is you have a higher rate on conventional here for the same down payment. However, you are not rolling that significant 1.75% fee into your loan amount, so you have less to pay back, and you can see that difference right here, of that difference of about $10,000 here. And so the cash to close is the same, even though it calls this a closing cost on FHA. It doesn't. It takes out that $10,000. It just wants you to be aware of it as a closing cost, but it doesn't include it in your total cash to close. So your total cash to close is going to be very similar between FHA and conventional. However, you're going to end up with different results. And yes, you have a higher monthly payment with conventional, but you're not paying that significant funding fee, which you are going to have to pay back over time. And then I mentioned I'd talk you through the process of making an offer and buying a house with FHA. And it's very similar to when you're the overall process is very similar to conventional. You'd start off by talking to a mortgage lender. You'd get pre-approved. Make sure they've had a look at your finances. Usually that starts, it depends on your scenario. It depends on where you get your money, what your income looks like. But generally they're going to need to look at pay stubs. They're going to look at a bank statement, and they're going to get you pre-approved to go shopping. You'll make an offer, you'll get your loan through and approved, and then you'll get the keys at the end of the day. It's the same with both. But a couple things that are unique to FHA, as far as and it starts with the approval process. Sometimes FHA loans, their guidelines to get approval for the loan are a little bit different than conventional, and sometimes they can be a little bit more painful. So, whether that's the inspection or just documentation that you need in order to get full approval for the loan after you've had your offer accepted, sometimes FHA can be a little bit more involved, and there can be more things that come up. So what that means is sometimes we looked earlier at the listing terms on this listing, and what that means is sometimes or real estate agents or sellers are going to specify that they wouldn't accept FHA offers. Or even if they don't specify that, if they have two offers come in that are very similar, but one of them is FHA and one of them is conventional, whether it's a good thing or a bad thing, sometimes sellers will be a little bit more reluctant to accept an FHA offer. So that's just something to be aware of. I did one for some clients where, because of FHA specific guidelines, the inspector had to come out to the house because of some chipping paint on a shed that was on the property. It wasn't even the house. The inspector had to come out several times during the process, and it delayed the process a little bit. And that was just because it was a guideline on FHA that wasn't true on conventional. So that's just something to be aware of. Besides that, they're very similar processes. Well, hopefully that's all helpful for you. Again, my name is Landon Buteau, and our team is licensed in Washington and Idaho, and we love to answer questions over the phone or email for anyone who just wants to ask questions. Or, of course, we'd love to help you get a loan and buy a house if you're ready. So please feel free to call or email using the information in the description on this video. My dad, Chris, has been in the industry 30 years, and he leads our team and advises heavily on every loan. I genuinely wholeheartedly believe in the value we can offer every borrower because of his experience. If you want to watch some of his videos, which are a little bit more in-depth explanation of strategies and guidelines on the mortgage processes, then you can check out his channel using the link in the description, or you can look for Mortgage Mastery Theater on YouTube. It should come up. I do these videos regularly on different houses that pop up, and the point is that over time with different looks at different houses, it's very relevant for you. So as interesting new houses pop up in our market, I'll keep doing these videos, and hopefully they'll be helpful to you. So please subscribe so you can see as new houses pop up where I'm running through the numbers.